His name is Charles Diebel, and he's head of market strategy at Lloyds Bank Corporate Markets. Thanks very much indeed for speaking to us, Charles.
Good morning.
So let me start by asking you, which do bondholders prefer, growth or austerity?
Almost inevitably they prefer austerity because it tends to protect the credit rating, and likewise austerity is weak for growth. It's disinflationary, so it broadly provides a very supportive backdrop for bond markets. But equally, you know, you can't really look at this in isolation as we're coming up to the elections in France and Greece this weekend. You know, populations are turning around and saying, you know, we need more time, we need a greater adjustment process, and really it's about the time frame involved that's the problem that these economies face.
How difficult is it to actually bring about growth? But I mean, just to go back to your exact quote, you're saying that growth through spending or a lack of austerity is a dangerous game. I mean, how can you achieve that?
That is exactly what policymakers are wrestling with at this point in time. I think ultimately policymakers in Europe will be asked a very difficult question, and that will be faced with a trade-off between meeting austerity targets that have already been agreed as part of the fiscal compact, or perhaps acknowledging some slippage in terms of the timetable of fiscal austerity. So the targets remain the same, but maybe they have an extra year or two to achieve them. But maybe as a payback for that, it will be the achievement of certain structural reforms. So there needs to be some sort of EU-level adjudicator to say, yes, okay, you've met your targets, you can slow down the pace of austerity, and thereby your growth numbers start to look better over the course of time.
Charles, where is the growth supposed to come from?
Well, again, it is things like structural reforms, but structural reforms take a long time to work, and they're inherently difficult to implement because it changes the way people live their lives. And that's the real problem here, is that we need growth now. We need support in terms of economic activity to help the Eurozone through this crisis. But structural reforms, absolutely necessary, but years to take place.
I mean, is it worth Eurozone countries sacrificing growth in terms of not meeting their budget deficit targets if it means that they re-establish the trust and credibility of European investors in the markets?
Well, I think that's really the key point, is there a policy mix that can be put in place that doesn't cause an investor flight and a further spike in yields? Because if you can achieve that, then, you know, buying time, if you like, i.e. an extra year or two in terms of how long it takes to get back to your fiscal targets, then, you know, as long as you can do that without the bond market punishing you, then I think policymakers would take that option.
Will this rhetoric that we're hearing increasingly here in Europe, the rhetoric on growth, is that enough to help ease the pressure on peripheral bonds? Could we see Spanish bond yields stabilise, for example?
I find it difficult to see. There is no magic growth bullet. I think it's interesting, this talk about sort of a Spanish bad bank. I think perhaps rather than limiting itself to Spain, we should be looking at this perhaps from the point of view of a pan-European institution that is there to, a bit like a European TARP, effectively, to take distressed assets off the banking sector to try and promote growth, and also separate it from the balance sheets of the sovereigns, because at the moment the banking balance sheets are becoming more and more inextricably linked to the sovereign balance sheets, and that's part of the problem about the whole growth story and lending and the credit cycle as one would normally expect.
So where is the best place to be in terms of assets in Europe right now? Is Germany the safest bet, or are yields just too low to make that investment worth it?
Both of those are true. I think Germany is the best place to be at this point in time, because the risks surrounding, for example, French debt are just too high, because well, you know, what Hollande does is an unknown quantity, and certainly some of the rhetoric that we've heard from him poses a threat to the fiscal outlook in France. But equally, I would also say that there's very little value in German yields at this point in time, but it is more about the return of deposit rather than the return on deposit, and for the time being I think that is the safest way to play. So you stick to core up until the moment that you hear that someone like Germany is softening its stance on accepting the liabilities for the rest of the Eurozone. Once that happens, then Germany is a very big sell, but we're not at that point.
So what about demand for other assets in Europe? I'm thinking about Norway, for example. Their 10-year government bond price recently surged, so yields have been falling. We're talking about a AAA rated country with a budget surplus. Would you be attracted are you attracted to Scandinavia right now?
Absolutely, and you know the same is happening for the UK market as well. Where, you know, those countries that are sort of around the eurozone but are not euro countries are certainly enjoying a safe haven flight to quality, or you know, a diversification bid, if nothing else. And this is something we're seeing reflected even from the central banks and sovereign wealth funds. You know, that this principle of diversification away from just dollars or euros to sterling, NOK, stocky. You're even seeing some of it into currencies like Australia and the Canadian dollar. It's all about diversification of risk, and that's going to be one of the guiding investment principles going forward.
Charles, I just want to pick up on something, a comment you just made about the moment Germany starts to show any hint of taking on the liabilities of other Eurozone countries, that's the time that you get out of German debt. When actually many policymakers and economists and analysts right now saying that is precisely the solution to all of this, is more integration.
Absolutely, it is. And if the Eurozone is to survive and you're going to move towards a long-term, stable and successful Europe, it is about economic integration. It is about things like Euro bonds and Euro bills. It is about some form of fiscal transfer union. And that, you know, I think is probably the inevitable outcome. But at the moment, that is not a politically acceptable solution. So I think for the time being, Germany remains the safe place to be, but as and when you get the idea of a fiscal transfer process being put in place in Europe, then Germany is effectively accepting responsibility for the wider Eurozone as a whole, or at least partially accepting responsibility, and thereby its fiscal outlook and its liabilities go up commensurately, and German debt is no longer a good place to be.
Charles Diebel, Head of Market Strategy, Lloyds Bank Corporate Markets, thank you.
Thank you.